All right, up to this point, we have become familiar with the introductory topics of technical analysis, and in this video, we want to start the discussion on advanced technical analysis with the very, very important topic of candlestick charts, or in fact, charts with candlestick diagrams. At the beginning, if you look at the next slide, we will provide some explanations about the history of candlestick charts, and then we will illustrate these charts on the stock price chart and actually on the software. Candlestick patterns were developed in the 16th century by a Japanese trader named Mr. Munehisa Homma, whose name I have written here. Mr. Munehisa Homma invented them in Japan. These patterns and formations actually show four main prices overall and operate on this price chart. As we mentioned earlier in the discussion on the history of technical analysis, Mr. Steve Nyson, a Swede, actually brought this knowledge from Asia and other regions of the world to Europe and the West in 1989 and gradually developed it into a science, turning it into the field of technical analysis, as you can clearly see in the next slide. These candlestick charts have very, very important and extremely significant applications. As you can see in this slide, I mentioned that candlestick charts sometimes form certain patterns either individually or in groups. These patterns are very, very important and are used as a series of strategies in the science of technical analysis for stock analysis. Gradually, they are also used in the Forex market during Forex courses where we fully explain these topics. Everything you learn here is fully utilized in the Forex market training courses. The weight of candlestick chart signals is a point I've brought up here, and you should pay close attention to it. In technical analysis, we should try not to rely solely on the signals from candlestick charts. As an advanced analyst, you should consider the formations that candlestick charts create and the signals they provide for buying a stock and learn them thoroughly. However, try not to give them too much weight in your final decision to buy or sell a stock, because in fact, it can be said that the error rate of these formations is much higher than the errors related to other oscillators, indicators, and tools that we learn in technical analysis. All right. Let's move on to the next slide together. Here, I have brought you an initial example of a candlestick or candlestick chart. Candlesticks generally have such an overall appearance. Of course, this is the general and solid appearance of candlesticks, but candlesticks can also take on other forms. However, in general, we have two different types of candlesticks which vary in color, depending on the skin color you assign to your stock price chart in your software. That's why I don't actually distinguish them by color. We assume candlesticks to be either hollow or solid. In a hollow candlestick, we generally have a low price at the lowest part of the chart, a high price at the highest part. And here's the important point, dear friends, take a look. Our open price, if you consider this as a box chart with a lower whisker, an upper whisker, and a box in the middle, the initial line actually becomes the bottom of the box. Your open price becomes the line at the top for your close price. Let me give you an explanation about the open, close, low, and high. Look, the low price of the stock in the market now with that high time frame, for example, consider now as we are recording this video. According to the regulations of the Securities and Exchange Organization, trading for the stock opens at 9 in the morning and continues until 12:30 in the afternoon. The first price at which a stock is traded after the market opens, we call that price the opening price or the open price. For example, consider that the stock of Iran Khodro Company opens at 9 in the morning, and at 9 and 4 seconds its first trade occurs. That first trade becomes the open price. It's an important price for us. In the market, these four prices are very important to us. What is the close price? the stock is closing at 12:30 in the afternoon and at 12:29, and for example 57 seconds its last trade occurs and it closes at 12:30. The trade that occurs at that time is considered the close price or the closing price of the stock. But from 9 in the morning until 12:30 in the afternoon, we see very different prices for the stock. For example, there might be over 2,000 trades conducted on the stock. The price at 9 in the morning, whether it includes the open price or the close price or not, the highest price at which a trade is made is considered the high price, and the lowest price at which a trade is made is considered the low price. Now, if the open price is less than the close price, the candlestick becomes hollow. Once again, I will mention the important point. If you see the open price is now lower than the close is higher. If the close is higher than the open, your chart becomes a hollow chart. Or in other words, we can say if the stock's price at the closing moment is higher than the price it had at the start of the morning, it becomes, in fact, a hollow candlestick, and the difference between these two candlesticks is precisely this point. You see, in a filled candlestick, the low price is the same, the high price is the same, but the positions of the close and open have switched. The close has come down, the open has gone up. So if the closing price of the stock is lower than its opening price at the start of the day, that candlestick becomes filled. Well, right here, before I move on to the next slide, I want to share a point with you, dear ones. Naturally, the general form of candlestick charts is like this, but if I have such a candlestick, what does this mean, kids? Take a moment to think about it right here, so we can actually examine it together. Well, here I am actually seeing a surprise. So my surprise is this area. This is my surprise. On the other hand, my candle is a hollow candle. So because the candle is hollow, my open price becomes this area. So this is my open. Right, kids? Now, this upper area. On the other hand, I know because the candle is hollow and this is the open price. So this is the close price. But the important point you need to pay attention to is that we don't have something called a high price in this area. So the same point, that is the close price, is also my high price. What does this mean, kids? This means that the price at which the stock closed was also the highest price at which the stock was traded on that day. For example, a numerical example. Iran Khodro came at 9 o'clock. And for instance, then at 1 minute past 9, its first trade was executed. At what price, for example? For example, it was traded at the price of 108 reals. Now this example is not real, 108, now 1080 reals. I write it to make it more realistic. For example, it was traded at the price of 1080 reals. It was the opening price, but throughout the day it had different prices. Even, for example, at 10 o'clock, and let's say 38 minutes, it reached the price of 1,000 and 10 reals. Well, that means lower than 1080 reals. That would be the low price. Again, it had various prices, until at the closing time, its price became 1190 reals, and that was its highest price. This means that throughout the day, the share price never went above 1190 reals. It closed at exactly 1190 reals. So the close price of the share was equal to its high price. Therefore, we have such a candlestick for the share on that day. Note that if you remember, when I was explaining the software on the Har-own chart, I mentioned that we must set the chart's time frame to daily so that we can have a daily candlestick for each day of the share. So let's pay full attention to this. All right, regarding this now, I'll draw another candlestick. And you tell me what happened to the share based on that candlestick, and we'll analyze it together. Assume our candlestick looks like this. What does this mean? Well, based on the explanations I provided, we naturally have a low price here. Naturally, this is our high price here. But if you notice, well, we don't see a box here. Or in other words, this box is completely closed and is a line. This means that this price and this price are equal. Or in other words, we can say the open price equals the close price. So when the open and close are equal, your candlestick will look like this, guys. What would a numerical example look like in the market? For instance, imagine Bojnord Cement shares opened here at 9 a.m. At what price did it open? For example, it opened at 3,083 rials. This share opened at this price. It hit various prices throughout the day, even reached, for example, 3,000. Now I'm typing these in Persian. Reached, for example, in 3,010 reals. And again, experienced different prices. It went up and down. The share reached prices, meaning it even hit 190 reals. But exactly at 12:29, and for example 47 seconds, when the last trade of the share was made, it returned to the same price of 3,083 rials and the share was closed. This means its open and close were equal. And on that day, it saw different prices, both lower and higher than this price. When this happens, the candlestick appears in this way. And now, as we move forward and get familiar with candlestick patterns, I will tell you that we call this candlestick. The name of this candlestick, kids, is a doji. A doji candlestick is referred to as a candlestick where the open price and the close price are equal. All right, let's move on from this topic. Let's go to the next slide. Here we are. Well, just a moment. Before I actually present these price formations to you, let me give an explanation. From this moment on, we have become familiar with the general view of candlesticks. Now we want to learn together the patterns or price patterns that candlesticks Ishang actually show us. From this slide onward, completely focus your mind and attention on these various formations that I will teach you and try to remember them as price patterns in your mind. These are very, very important. Later, you can also use these candlesticks in the Forex market. The first formation I want to teach you, dear ones, is the Doji formation. A very important formation, which we can see its shape here now. Let's look at its shape together. Look, dear ones, this is the same formation that I mentioned as an example in the previous slide. We have a Doji where, in fact, you could say the open price and the close price are equal, which actually has a low price and a high price, but the open and close are equal. But the important point you need to know about the Doji candlestick is that these dojis themselves are divided into different types. Let's look at its types together. The first type of doji we call the dragonfly doji. As you can see, the open price and close price are equal. And what are they both equal to, guys? They are equal to the high price. That means the open, close, and high are equal. We have a low price below, but the opening price, closing price, and the highest price were the same price on that day in the market, which we call the dragonfly doji. There is another type of doji that we call the long-legged doji. This means a doji that actually has a very, very high low price and close price. You see, during the day in the stock market, your share has a range of fluctuations. It means that your share doesn't just take any price. According to the stock exchange regulations, a share can have a fluctuation threshold, an upper and lower limit, and it cannot go above the ceiling or below the floor. When you have this floor and ceiling limit, sometimes the share even goes to its lowest range. For example, suppose the fluctuation range of a share during one day is 5%. What does this mean? It means the share is allowed to grow by a maximum of 5% or fall by a maximum of 5% on that day. This growth and decline together make 10%, meaning from -5 to +5. It means it can reach 0% or higher. Now, the point is that in one day, a share might drop so much that it even experiences -5, and on the same day, its trading might grow so much that it goes into a buying queue and experiences +5. When the gap between the low price and the high price is very large, when the share experiences its entire fluctuation range on that day, we will have such a doji. We call it a long-legged doji. And we also have a third type of doji, which we call a gravestone doji or tombstone doji. It has such a name in Persian books, and this doji is among those dojis that in fact can be said to be the opposite of the dragonfly doji. This time, the open price, close price, and low price are equal. We have a high price, but the open, close, and low are all equal. Well, we have learned these three dojis, but what signal do they give us? When you encounter a dragonfly doji, you can predict that after that day, the market is likely to be accompanied by good news, and subsequently, the stock will actually start to grow. But conversely, if you become familiar with a gravestone doji, it indicates that after that, the market is not likely to be favorable for that stock, and the stock will start to decline. If you encounter a long-legged doji, it actually represents a state of indecision. This means you should be uncertain about what is going to happen in the market. This is essentially your understanding and recognition of dojis and the decision you want to make afterward. But as you remember, I mentioned to you, you should be familiar with the schematic representation of dojis and the signals they give, but do not pay too much attention to the signals from price patterns or candlestick formations.